Manager Greg Kuhl and Slate Stone Wealth's chief market strategist, Kenny Polcari. Kenny, we cannot ignore the small and mid caps. Look at the Russell move today. It is far outpacing anybody else.
The move today plus the move last week. I mean, it had a massive move last week, and then today it's up another 1.5% as of right now. I think that speaks volumes, not only to what people expect, but kind of where they expect not only rates to go, but where the economy to go in this new administration.
I mean, look at this gain, 1.5% to 24.33.
It's nuts, right? I think it gained 9% just last week between the election and Friday afternoon.
So is this a Trump trade too?
I think part of it is a Trump trade. I think part of it is also the realization that, with the Trump trade comes less regulation across a range of industries and very supportive of the U.S. economy. And small and mid caps do very well when the focus is on the U.S. economy.
And you got to believe, Greg, that if there are onerous tariffs that are slapped on every other foreign country trying to import stuff into the U.S., people will be forced to buy U.S.-made products, right? And a lot of that comes from the Russell 2000.
Yep, I think that could be fair. And in my world, which is the listed REITs and real estate stocks, a lot of those are mid and small cap companies as well. And there's an old saying that commercial real estate is the landlord to the economy. So, there's maybe an inflationary aspect to tariffs, but there's also could be a growth aspect to other things that might happen, and that would be good for my space.
Okay, so if we're looking at the REIT that you guys run, that's Janus Henderson REIT, it has had a very nice move, and you can see up about 33% since last November. I mean, I'll take that. That's impressive. But now, if we do get the tax cuts, and by the way, we're going to take you live in just a few minutes to Washington, D.C., because we really need to see the breakdown of what tax cuts that President-elect Trump might enact could be realistic and some non-realistic. But if you figure that there are tax cuts and tariffs, that could be inflationary, and that means the Fed won't cut rates. And usually it's the real estate names that really love lower rates, right? So do you model that into the picture that they might not get them?
There's a lot of uncertainty right now around rates. I think that's the thing that's certain. But the way we think about it, it's not obvious to me what's going to happen from a policy perspective. We just don't know yet. And a lot has been priced in if you look at rates over the last 6 or 8 weeks. There are two sides to this coin that could impact rates in either direction. So I think it's a little premature to say they're definitely going to go higher. The good news is for the REITs that we invest in, they're public, they trade every day. We think they're pretty much priced for the rate environment that exists right now. So in my view, base rates being flat is fine. We have fundamental growth in REITs from occupancies and rent growth. Mm-hmm. Lower rates is obviously good. So if you think about 2 of the 3 things that can happen to rates based on where we are priced today, they're either fine or potentially really positive if we end up seeing rates go lower and the Fed does keep cutting.
Yeah, well, so the Fed takes kind of a backseat, Kenny. I'm not sure, but if we look at the fact that we're going to get the consumer price index for October, so econo data, folks, we're getting a lot of it this week. Wednesday is the CPI, the latest read on inflation.
And then Thursday's PPI. And it's supposed to come in line, right?
Friday.
Oh, Friday is PPI. It's supposed to come in line, right? So it's not necessarily going to surprise to the upside, or at least we don't think it's going to surprise the upside, but nor is it going to surprise to the downside. So I think that just continues Jay Powell's narrative about inflation coming under control and about him, being data dependent, waiting to see what are the data points against before making a decision. But look, I think he was very clear when he cut rates by 25 basis points last week. I think he left the door open to potential more rate cuts, but he didn't commit himself to December or even early January. And I actually think, I didn't think they should have cut them in November, but they did. So I don't think they're going to cut them in December, just because I think the data is too strong.
The data is very strong.
Too strong.
Right. I mean, 3.3% is the expectation for inflation, Greg, coming out on Wednesday, year over year. Core, that's ex food and energy, which are often seen as volatile. Greg, can I just ask you to broaden your aperture here? And as you look at the entire market, what do you see ahead? I mean, there's so much excitement on behalf of the bulls, because we do have a president-elect who is considered very pro-business and anti-regulation. What do you see on the horizon that could tamp down some of this euphoria, so to speak?
Well, as you said, there's certainly some positives. Broader market, I would think, one potential governor on things could just be absolute valuation levels. You highlighted at the open how many records the S&P has seen very recently. So that could be one thing. Or if there is a negative impact in some of these policies as it relates to interest rates, I would think, if the 10-year yield goes from where it is today to 6% or higher, something high, that could put a damper on all capital markets potentially. Not our base case, but those would be some potential negatives out there. On the positive side, growth is good. Growth is good for the broad market.
Yeah.
Pro-growth policies are good for real estate and REITs as well.
So I think if we see rates, Greg, go to 6%, that's clearly going to be an issue for the markets. I think 5%, where we saw it go a couple of months ago, 6 months ago, when we hit 5%, we saw how the market struggled, then it backed off. So I would not be surprised to see rates test and kiss 5% again. I don't think we'll go to 6%. And if we go to 6%, then it's going to be a different conversation we're going to have.
I'm not hearing either of you guys say market correction.
No.
Okay, so we'll leave it there. Great to have you both. Greg and Kenny, thank you so much.